Well, the Federal Reserve released its Beige Book report. Why is it called a Beige Book? Well, here it is. It's beige. The report is a collection of data from the Fed's 12 districts across the country, and on balance, the economy is slowly growing. But there's concern that the price drop in oil will actually end up costing jobs in the energy sector. And for more on this and the other economic news of the day, we're joined, of course, by our friend Jim Awad, Managing Director at Plimsoll Mark Capital. Jim, as always, welcome back to Arise Xchange.
And as always, it's my pleasure.
So we'll start with the Fed report because it is kind of, they say it's an anecdotal, I don't know what that means, anecdotal collection of stories. The Fed governors get up there and tell little stories, like, Walt Whitman poems or something. Any surprises from this report?
Actually, it was a little bit more downbeat than I think most people expected. It's interesting that the market stopped going down and, in fact,
I don't think they read it.
Yeah, I think it really was about the rally in oil. People are attributing it to the Beige Book. But this is the most downbeat I've seen, or less upbeat I've seen the Fed in several months that they've released these reports.
What are they citing as some negatives?
Well, it's oil. They're saying that whatever the long-term benefits of declining oil prices are for consumers, it's more long-term if consumers choose to spend the money, whereas the decline to the oil industry is almost immediate because a lot of these new wells are short production wells. They go on and off very quickly.
And it's interesting because I would think we have more oil-based jobs now than we did in the last 20 years or so because of fracking in places like North Dakota, for example. And maybe that's going to take a hit that we would not normally have seen in years past.
Right. That was a lot of the job growth that we've experienced, and it was high-paid job growth.
Yeah, good jobs.
So it's a double whammy on the downside. And what they're saying is they're starting to see the effects of this. And it's interesting, it was coincident with a terrible retail sales number. After having good October and November, we ended the year not so good. And what's also interesting is luxury sales look like they're softening. So there were valid reasons for commodities to be going down.
And we saw retail sales drop, and we kept talking about how the price in oil means everyone gets a little bit of a tax refund because they're paying less at the pump, would translate into better retail sales. We certainly didn't see that. And any news behind these retail numbers?
Well, 1 month, it's too early. It can be revised, and it's only 1 month on the back of other numbers that had showed the economy getting better and the consumer getting better. So let's see what happens January, February, March. But you have to say it's definitely not a good thing, and it flies in the face of a lot of the other numbers that we have been seeing in the economy. The big picture is the United States is the pillar of strength in the world. The rest of the world is not doing well, and the real economic question is, can we continue to power through while the rest of the world suffers? And is the bond market and the commodity prices telling us that maybe that's not the case? And that's what the markets are worried about.
Yeah, and today we saw a sharp drop in commodities.
Yes, and I think what's starting to filter into the markets is a fear of the credit markets, that there might be an accident in the credit markets due to a decline.
What do you mean by an accident in the credit markets?
Well, 20% of the junk bond market are small oil companies generated around the shale oil.
And we should say junk bonds, their name suggests that they're very bad, but these are basically just subprime bonds. Anything other than a AAA rating or a AA rating?
Yeah, well, I think it's below a AA, not a AAA. But the point is, it's the mostly non-bank shadow market loans to less than prime borrowers.
High interest rate delivering bonds.
Right,
and so you think we could be in a situation where we have a junk bond collapse,
default somewhere that freezes up the system. Now, most people think you're about $5 away in oil before that happens, but every day that oil goes down, I think the markets get a little bit more nervous. And then there's Venezuela, there's Russia, and they both and Russia's about to be downgraded to junk status, so I think the markets are worried about that. And then don't forget Greece, which may elect to leave the euro, and is that going to be as smooth as the Germans have led us to believe that they think it will be?
Well, everyone's pretending that Greece is almost irrelevant when I'm not so sure about that, right?
Well, if you're a bank that's loaned money to Greece,
that's not so irrelevant,
sovereign,
right?
Yes, it's not so. So there's a lot to worry about within, but don't get too bearish, because right now, as we sit here today, the U.S. economy is still growing at a reasonable rate, and until recently, an accelerating rate. So we're at an inflection point where either we're going to find out that all these worries were wrong, the commodity worries were wrong, the bond market was wrong, the softness in retail sales was temporary, and the United States is going to grow nicely.
And it's just 1 month.
And it's just 1 month. Or we're going to find out that this was the beginning of a slowdown. So I think it's a time to be careful, watch, wait, and be willing to go either way.
Jim Awad, as always, thank you so much.
Thank you.